Welcome to our video on cost classifications in manufacturing. There are two types of costs: direct costs and indirect costs. When a product is manufactured, there are different types of costs that are associated with it. Direct costs are costs that can be directly attributed to a specific cost object. For example, the cost of raw materials used to manufacture a product is a direct cost. Indirect costs, on the other hand, are costs that cannot be directly attributed to a specific cost object. These costs are usually associated with the production process as a whole. For example, rent, utilities, and salaries of supervisors. Now, let's move on to the three basic manufacturing cost categories. The first category is direct materials, which includes the cost of raw materials that are used in the manufacturing process. The second category is direct labor, which includes the cost of labor that is directly involved in the manufacturing process. The third category is manufacturing overhead, which includes all indirect costs associated with the manufacturing process. Examples of manufacturing overhead costs include rent, utilities, salaries of supervisors, and other indirect costs associated with the production process. And that's it for our video on cost classifications in manufacturing. By understanding these concepts, you'll be better equipped to assign costs to cost objects and make informed business decisions. So we're going to cover two important cost classifications used in accounting: product costs and period costs. We'll also talk about cost behavior, which can be classified into variable costs, fixed costs, and mixed costs. Let's start with product costs. Product costs are the costs associated with producing a product or service. These costs include direct materials, direct labor, and manufacturing overhead. Direct materials are the raw materials used in the production process, while direct labor is the cost of the workers who physically make the product. Manufacturing overhead includes all other costs, such as rent, utilities, and insurance of the manufacturing factory. Once all of these costs are added together, we get the total product cost, which is used to determine the cost of goods sold on the income statement. Next, let's talk about period costs. Period costs are the costs associated with running a business, but not directly related to producing a product or service. These costs include admin and selling expenses, such as management salaries, office rent, and advertising. Period costs are reported as expenses on the income statement and are deducted from revenue to determine net income. Now let's move on to cost behavior. Cost behavior refers to how costs behave when production levels change. There are three main types of cost behavior: variable costs, fixed costs, and mixed costs. Variable costs are costs that change in proportion to the level of production. An example of a variable cost is direct materials. The more product you produce, the more materials you need. Fixed costs, on the other hand, remain the same regardless of production levels. Rent is an example of a fixed cost. You pay the same amount regardless of how much product you produce. Mixed costs are a combination of variable and fixed costs. These costs change with production levels, but not in direct proportion. An example of a mixed cost is electricity. You'll pay a base rate every month, fixed cost, but then the more electricity you use, variable cost, the higher your bill will be. Understanding cost behavior is important for budgeting and forecasting, as it helps businesses plan for changes in production levels and their impact on costs. When making decisions, it's important to understand the types of costs involved. There are two main types of costs: relevant costs and irrelevant costs. Also, we'll learn how to prepare income statements for a merchandising company using traditional and contribution formats. Relevant costs will change as a result of the decision being made, such as the cost of materials needed for a new product. Irrelevant costs will not change as a result of the decision being made, such as fixed overhead costs. Let's move on to income statements for a merchandising company. There are two formats commonly used: traditional and contribution. The traditional format separates sales revenue, cost of goods sold, and gross profit. Operating expenses are then deducted from gross profit to arrive at net income. The contribution format separates costs into variable and fixed. Sales revenue less variable costs equals contribution margin. The contribution margin is the amount of revenue that's left over after deducting variable costs. It can be used to determine how much revenue is needed to cover fixed costs. By using these two formats, businesses can gain insights into their sales and costs, and make informed decisions that will help them grow. That's all for today. See you in the next video.